Obviously, fireside chat, a little less formal than a class, a little more of, here's some useful information. We like to call it the quick hits, where it's like, here's a few topics that are kind of top of our mind, things that we're looking out for in the news. And yeah, so kind of reiterate off of, I think the last fireside chat, Sean focused mostly on the property tax reappraisal. So if you didn't know, the county reappraised taxes for every home in Cuyahoga County and sent out letters to all residents letting them know what their new reappraised value is. And for most of us, myself included, I live in Cuyahoga County, your taxes went up. So, or at least your valuation went up. Doesn't necessarily mean your taxes went up, but more likely than not, when they adjust valuation, that in turn means the taxes are adjusted as well. So, they, oh, some more people in the waiting room. So they finally updated the property tax estimator on the county auditor's website, which is great because previously the dates were wrong, it didn't look right, it was a little clunky, and then after everyone sent out, after everyone received these letters from the county, everybody went to the tax estimator to see how bad their taxes were going to change, and it crashed itself. So it was down for like a week. So this is more of just a general announcement, following up on last Fireside. The tax estimator is back up and running, and the verbiage is correct on here. You can plug in your previous tax value, your new tax value, the school district or tax district that you're in, and you can figure out how much your tax is. So for myself, my valuation went up pretty big, but my taxes didn't jump that much. Certainly not the percentage of the jump that the appraised value was. So might be worth it. Eric Duckbar has a great class about getting ahead of this and using it as a tool to call your previous homeowners. I know in firsthand experience from working with people, they get that new tax bill, they find out how much their taxes are going to go up. But for some people, if you're in like Shaker Heights and all of a sudden your taxes went up an extra $2,000 a year, you might say, well, that's enough for me. I'm getting out of Cuyahoga County. So you might have a deal. You can turn this into maybe double-sided, a sale and a buyer. So yeah, just some good information, and you can let your clients know that they want to. Any questions on the taxes or the estimator or anything like that? No? As always, reach out to one of us if you do have questions or someone's, looking for some more specific information. Feel free to pass my information. So, all right. So the main focus today is going to be the market. Interest rates took a big turn over the last 2 weeks. There's been a lot in the news, inflation, jobs reports. So I want to get into a bit of the numbers on that and give you an idea of where we stand. We're certainly entering what seems to be the transition back to affordable interest rates. We're at the beginning stages here, but all signs point to rates making their way back down to at least palatable levels. So you can see on this page, as of today, this is where we stand. These are national numbers. This is a survey they do of like 500 leaders all across the country. Some of these numbers, maybe that when they fill the survey out, they include some points. Usually this is, 20 to 25% down with grade A credit. So you can see someone with pretty good credit with a good down payment on 30-year loans. 3 weeks ago, that was probably closer to 7%. So we're a 0.5% better over 3 weeks. That's pretty crazy. Usually you don't see that dramatic of shifts. So I wanted to kind of get into what's causing all that. Why would that be happening? So there's really two big factors that markets look at whenever they're determining, what interest rates to sell at a retail level to individual purchasers. And right now, that's, let me go back from here. Mortgage bonds, which is mortgage-backed securities, that's this chart here, and the 10-year treasury is this chart here. And they work counterintuitive of each other. So when one is up, the other one's down. And if you just want to, kind of take a note here, when the 10-year treasury is down, that's good for interest rates. You're going to get more improved interest rates, lower interest rates when the 10-year is down. As you can see here, we're on a bit of a run where it's pretty consistently trending down. At the same time, mortgage-backed securities work in conjunction with improving. You can see as this improves, rates improve. So think of it as if you're a person who's got $100 and you want to invest in something in the stock market, and you're being told there's only two things you can buy right now. Do you want to buy 10-year treasury notes from the U.S. government, or do you want to buy mortgage-backed securities? Mortgages that are being packaged at the federal level, whenever they take all of the mortgages across the country and then lump them all together into an investment. And right now, the trend is we're getting away, or investors are getting away from investing in the government and instead investing in mortgages, which is a good sign. A big part of that is the expectation of what the Federal Reserve is going to do with interest rates. So without getting too much into the whole, bank theory and how money is created, just simply put, here in the US and then most of the world, the government holds the ability to create money by lending out at the federal level through the Federal Reserve. So if they lend out money at a low interest rate, that promotes the creation of money. That means that money is more affordable and you're going to see more activity in the market. On the flip side, when rates are up at the federal level, they're trying to slow down the market. They're trying to, slow down something like inflation, which is exactly what we've run into over the last couple of years. Well, when you have 2 years of relatively high interest rates, the expectation is you're going to see a slowing market. And I'm going to flip over to this report here that just came out today. This is the Consumer Price Index. It's basically an inflation report. Think of it nothing more than how is the market doing? How is spending happening? The red line here is the trend of prices, and this is how quickly things are increasing. They're not decreasing in price. This is how quickly they are increasing. For all things minus food and energy, so sometimes it's a good idea to cut out food and energy because people have to eat and they have to drive to work. So it's not really a good indicator of what people's discretionary spending is. But you can see in both respects, we're trending down here, which means inflation is improving rapidly and has been here over the last year. The key indicator that the Fed is looking for, they want to see jobs going down, which rather unemployment going up. That means that employers are being a little more cautious with their spending. They also want to see in inflation reports, inflation coming down. That means that consumers are being a little more cautious with their spending. Those two things together mean a slowing economy, which means, all right, we can go ahead and start lowering interest rates. And they've been aiming for a target of about 2.5% on the inflation report. For the last 2 years, they've said, yep, we'll talk about lowering rates whenever we can get back to 2.5%. The print today came out at just above 2.8%. And pretty much everybody in the market is saying that's close enough. We expect they're going to start lowering rates. So lower federal rates means lower retail rates for your buyers, my clients, your clients. So it's good news. So something I like to look at is this website here called CME Fed Watch. Basically, a bunch of economists, they survey and they say, hey, everybody, if you had to guess what the Fed is going to do at the next meeting, what do you think? Right now, where rates are currently is 5.25 to 5.5%. So if you're the person that gets it straight from the, the money straight from the hose, more or less, that's what it's being, charged more or less at the federal level. The reason that your clients get a 6.5 or a 7% interest rate is because everybody else that touches that money until it makes it all the way to them purchasing their home, everybody takes a cut. So that's where we are currently. Really, rates are kind of where they are right now. They're kind of pricing in an expectation of lower interest rates here in the future. So those economists that are being surveyed, 56% feel that rates could go down by a quarter. A little less than that, 43% feel it could go down by 0.5%. That's a big drop. That's a fairly dramatic drop. We jump forward to November. There's no meeting in October. When they meet again in November, almost half feel that it could go another 0.5% further. If that happens, that means we dropped 1 or 3/4 to 1 full percent at the federal level in just a handful of months. That's pretty dramatic. You're going to see rates start going down really, really quickly if this happens. We go even further into December, you can see they feel very likely the rates are going to go even further down. And if we skip out all the way to next year, you can see the majority of people this time next year feel that the federal rate could be closer to 3%. If that were the case, you could expect retail interest rates to be closer to 5.5%. And if someone's paying some points, they might even have a 4 in front of that. So that's a wildly different market that we're looking at this time next year versus right now, just purely on the amount of money that will be going towards interest in someone's monthly payment. I mean, the difference in the 2% lower interest rate for your average mortgage, that's hundreds of dollars. So that's obviously good news. There's a lot of factors in here. Obviously, when we have higher unemployment, that means some people are going to be losing their jobs. They're looking for new jobs, furloughed, laid off. Obviously, that might slow down someone's interest in purchasing a home if they're between jobs, if they're uncertain about their job security. So that plays. What I've been telling everyone is, there are some recession-proof or recessionary safe jobs out there. Teachers, people within local government, first responders, nurses, doctors, teachers. I think I mentioned the first. If you're talking about people that very unlikely that they would get laid off, that's probably a really good kind of target base to see if you can get in and introduce yourself to those groups, or if you know some people, maybe reaching out and reconnecting with them, just because if they're fairly certain that they have job security, they're going to be able to take advantage of these interest rates as they start to go down. The other thing I kind of wanted to touch on was the interesting gray area we're entering into here, where anyone that's going to be willing to get off the fence and purchase this fall, this winter, normally a time of year where most people don't want to purchase unless they absolutely have to. They just don't want to move in the snow. It's not really, we always see a trend where people slow down, or the purchase market slows down in those times of year. We're going to be running into rates going down at a time where a lot of people are delaying their search until the weather improves or until next spring. If someone's willing to get out there, they might be able to avoid having to deal with, the multiple offers and the asking over the appraisal gaps, and still take advantage of these lower interest rates. If they hold off until the spring, sure, rates will probably continue to go down, which is great. But now they might be in a multiple offer situation where, who knows that heck, the rate goes down, which is great, but now you're offering 10, 15, $20,000 over asking. Maybe that washes it out, or maybe they're coming up with extra cash. I just think that there's a sweet spot here if someone's willing to get out there where it's a win-win. They can take advantage of the market and get something at a time of year where it's not so competitive. So I know that's a lot of economics. Does anyone have any questions there? Cool. So wanted to talk a little bit about refinancing as well. And obviously, this is not necessarily something that you would be selling all that much because, refinancing, no one's doing a purchase in that scenario or a sale in that scenario. But just so you know, we do have a promo going for refinances good through the end of next month on refinances happening this year, where we waive our $1,500 lender fees. Might be good for someone. Oh, did you lose me? Can you hear me? Can you hear me? Oh no.
I have a question.
Can you hear me?
Yes.
Okay.
I have a question.
Sure.
If would it be in buyer's best interest to buy when the rates have not come all the way down and then refinance when they do?
Yeah. No problem there at all. I mean, just as an example here, over the last couple of weeks with the rates moving lower, I am reaching back out to people that closed October when rates have hit an all-time high.
You're breaking up a little bit now. I'm sorry. You were breaking up. Pretty much.
Okay. Absolutely. People can refi down the road. Makes all the sense in the world. Honestly, I'm working with people now who closed last October. I've got a guy who closed at a 7.75 interest rate on a VA loan. If he refinances right now, the VA rates are really, really good right now. They're at like 6.25%. He might be able to save as much as like $400 or $500 off his payment. And his home actually went up like $20,000 in value between last year and this year.
Mm-hmm.
So,
because I was thinking in terms of less competition and not getting into obviously the prices for the properties will be less now, because, or not less, but less competitive.
You're absolutely right. Yep. And we were advising that the whole time. We've had this promo going for a long time. Basically trying to say the same thing, like, hey, go out now when it's not going to be as crazy as it was in 2020 and 2021. Get into something, get settled in, and then when the rates work their way back down, we'll refinance you and you'll take advantage of the lower payments.
I mean, to me, that just stands to reason now. I mean, I think that's a real opportunity for us to try to generate some business now. You want to buy a house? Yeah, in the short run, you might have to be paying this, but it looks like by next year, the cost of refinancing will, the interest rate will offset the cost of refinancing, I would think.
Yep, you're absolutely right. Yeah, in many cases, as long as they've got some equity. But yeah. So, I mean, the nice thing about where we are now, it was a hard sell in 2022 when rates had first gone up, because a lot of people were like, who knows when they'll ever come down.
Right.
Now, it looks like they're going to come down. As soon as the Fed actually drops the rates for the first time, it's going to signal to all of us that, oh my gosh, we finally made it here. 2 years later, we finally made it to where the rates are going to come back to a more palatable level. It's going to be a lot easier to advise our clients that, hey, the rates are going down. They will go down someday. We don't know when. They are going down now.
But at least we're moving in that direction, right?
Exactly. Yeah, exactly.
Thank you.
Absolutely. Any other questions?
I wanted to hear more about the 20-year loan.
Oh yeah. So right now, the lower term loans, the 20-year and the 15-year, are really, really, really aggressive on significantly. We've been closing loans over the last month or so here, where if someone is doing a 20 or a 15-year, maybe pay a point, a little bit of cost out of pocket, they're looking at an interest rate, anywhere from like 5.75 to 5.9. And that's, as far as the monthly payment goes, when you get under 6%, the interest per month becomes a lot more palatable. It's not as crazy as a 30-year at 6.75%, where you're maybe putting $100 towards principal.
Mhm.
I'm going to give me one second here. I'll pull up something that I think is really good. And if you ever send anyone to us, Don, myself, Don Jarecki, we are going to pull this chart up. Come on, let me screen share. There we go. And this is how I like to visualize this for my clients. So let's look at a $200,000 loan, just to use some round numbers here. Let's look at a 30-year loan at 7%. Once again, just kind of using round numbers.
Bambi Brown.
Total interest paid.
Oh, Maria.
Hi, Maria. It's Bambi. How are you?
Doing well. Hi.
Good. Hey.
So on the 30-year at 7%, total interest paid is $280,000. So over the life of the loan, over 30 years, you're going to pay $280,000. If I look at a monthly schedule, in the beginning here, you're only putting $163 towards your principal. Instead, let's look at a 20-year at 6%. So your interest rate's getting better and the term is getting better. You shed $100,000 in interest over the life of the loan, and you're putting $430 a month towards principal instead of only $160. This person's going to build equity so much faster. They're going to spend $100,000 less dollars over the life of the loan. It just makes so much more sense. You want to take it even further, go to the 15, let's say 5.75%. Paying less than $100,000 over the 15-year life of the loan, and they're putting $700 per month. Now, the people you're not going to see going for these lower terms are usually first-time homebuyers, someone with a fixed budget. These are more people that are not purchasing at the top of their debt-to-income ratio. They can pallet a higher payment because you're simply paying less over the life of the loan, or because it's a shorter term. Your payments are going to be, a few $100s higher than the 30-year. So there's the right kind of person fits into this, but man, just so most of the time, if I have someone that can handle it, they can take on a higher payment, and I show them this chart, they go for it every time because it's like just the idea of over the next 15 years, I'll save $100,000 versus paying on this for 30. Now, obviously, most people don't live in their home for 30 years. Most people don't have a loan for 30 years. They wind up refinancing. But good information to have. So great question, Maria, on the 15 and the 20. Any other questions? Open forum.
Did you say that there was something for teachers? Because I've got a daughter who's a teacher looking for a house.
Yeah. So, earlier when I was talking about teachers, I'm just thinking most people, they're in that line of work. Their jobs are a little more secure. Kids are going to school regardless of how the economy's doing. So a little more recessionary proof. Now, if you've got teachers that are first-time home buyers, I got a program for you. Let's go. Ultra Heroes. The Ohio Housing Finance Agency, so division of the Ohio state government, has a program for first-time home buyers, heroes, and recent graduates. Here are the requirements. If they're buying here in like Summit or Cuyahoga County, the income limits are, I want to say $116,000. You can purchase all the way up to, I think, 400,000 and qualify for the program. There's down payment assistance, and there are super low interest rates. So, and that's not just for teachers. So I want to mention this too.
Do they have to be a first-time home buyer as well? Or that's separate?
Yep, first-time home buyer.
They have to be a first-time home buyer.
Yep.
So the fact that she owns a condo now,
Yeah,
she wouldn't
what-
qualify.
Yep, couldn't take advantage of the program.
Okay.
But if she has friends or coworkers who are first-time home buyers,
Yeah.
veterans, active duty military, police, fire, EMT, paramedics, physicians, nurse practitioners, RNs, LPNs, STNAs, teachers, admin, and counselors. This program is awesome. I'm doing a ton of it this year just because a lot of the people that are in the market are first-time home buyers, and a lot of them either want to take advantage of one of these programs just because why not, or they need to because they need some funds. And the rates are aggressive. So let me show those to you. If you're getting a conventional, I'm sorry, a government loan, so like FHA, VA, USDA, and you qualify for the Heroes program, they give you 3 options. You can get no assistance from the state and get a 5.75 interest rate. You could take 2.5% of the purchase price to go towards your down payment and closing costs. Rate's a little bit higher at 6.25, or you can get 5% to go towards the down payment and closing costs, and you're looking at a 6.75% interest rate. Those are all really aggressive considering the amount of assistance you're getting. And this 5.75, if you're talking about an FHA or a VA loan, that's about 0.5% better than what you're going to get. And that's just the state. You know, it's a bond program, so they sell it almost like a treasury. So it's a bond. People invest in it. The money they make from it, they give it back to the home buyers. So there is a conventional portion of it as well. The rates are a little higher, but the nice thing about going conventional is if you're a first-time home buyer, your down payment can be 3% instead of 3.5%, which is nice. They do have a next home, which is if you're going to be a home buyer, you can get 2.5% assistance. So I'm pretty sure actually, Maria, your daughter might be able to do this program. The interest rate's a little bit higher, and the assistance would only be 2.5%.
Yeah.
And-
Have to see if the numbers.
Yeah.
Yeah.
Usually what I tell people is like, if we can come up with a minimum down payment, I might avoid this program just because I could probably get you a better rate than this anyway. Right.
Yeah.
There's something called MTC through the state of Ohio, and that is a mortgage tax credit. And basically the state allows you to write off additional mortgage interest on your state taxes. You know, used to be that you do that on your federal taxes. They changed it over the last few years, so the standard deduction makes more sense. Well, with this program through the state, if you qualify for their MTC, you can write off this interest on your state taxes as well. And I can't remember what the amount is, but I think you can get a refund of up to like $2,000 a year. And it's for the life of the loan. So as long as you have this loan, you can do this forever. So I don't have a ton of people doing it, just because where the interest rates are. Obviously, the rates
Yeah.
are a little
Too
higher,
high. Yeah.
but you know, if the numbers ever work down a little bit and it makes more sense, we have a loan officer in our branch who just loves this program. Because it, you know, an extra $2,000 refund every year is a lot of money come April. And then they do have a refinance program through the Ohio Housing Finance Agency. Normally, the way that the assistance on this program works is you get your 5% or your 2.5%, and that shows up as a second lien against the property that's on there for 7 full years. And at the end of the 7th year, the state forgives it. It just disappears. If you were to sell or refinance before the end of that 7th year, the buyer has to pay all of that back out of the equity they have in the property. And, you know, I don't even want to have, you know, throw it out there, but if the home ever went down in value, then you would have to pay it back, you know, out of pocket. I don't anticipate something like that happening, but that's kind of the worst case. If you wanted to refinance, you can, but you got to do it through them. Once again, the rates are kind of high, so it's, I don't know if it makes all that much sense. At least
No. Yeah. Okay.
So, cool program. Like I said, doing a lot more of them this year than we have ever before, just because people want to take advantage of what's available. Any questions? Cool. I think that's all I had today. Any questions about literally anything at all? Any other questions of any kind? No? All right, well, I appreciate it. Keep an eye out when we do this again next month. Obviously, it was just me this time, but if you need any help, you can get a hold of me, Sean, Don Jarecki, and then hopefully next month, we'll all three be back on the call, and hope to see you all there. Thanks.
Bye. Thanks everyone for joining. Thanks so much,
Thank you.
Chris, for taking.
Thanks.
Thank you.
Have a